Hello, and welcome to the next in your series of video lectures. Today we're going to talk about Chapter 10, International Financial Management and International Accounting. The objective of this chapter is not to make you experts in international financial management or international accounting, but to have you understand some of the issues and some of the responsibility of international financial planners and international tax accountants. We're going to talk about things like hedging, we're going to talk about currency risk, we're going to talk about spot rates, and the different tasks that financial managers have to go through when they're doing business on a worldwide basis. We're going to talk about how firms in the international market raise money through debt and equity financing and other concepts such as that. So with that being said, again, the objective is not to make you financial accounting or financial management experts in the global market, but just to give you an understanding. And with that, let's get started. As I said in the introduction, today's chapter is all about financial management and financial accounting in the global marketplace. So, international financial management really is the acquisition and use of funds. Many MNEs or multinational enterprises need funds both long-term and they need funds short-term. Long-term, they might need funds to do a foreign direct investment, build a plant or something in somebody's in a foreign country. They also might need some short-term funds just to meet payroll while they're waiting on some money to come in from accounts receivable and those types of things. The big thing is MNEs use a multiple of different foreign currencies and a multiple of different foreign funds in order to meet these long-term and short-term needs. Remember, you can do business in just about any currency you want as long as that currency is translatable into either dollars or some basket of goods. So firms access funds in a variety of ways, from banks, from people, from investors, from hedgers, from speculators, from all types of things. And that's what this chapter really is all about. So there's 6 tasks in international financial management. These 6 tasks are what we're going to talk about over the next 25 slides. Number 1 is to choose a capital structure, debt versus equity. Number 2, raise funds. Number 3, raise working capital and cash flow, working capital for both long-term and short-term. Task 4, budgeting, ensuring that you have some money set aside for projects to make payroll and for a rainy day. Managing currency risk. That's one of the most difficult ones because no one has a crystal ball. Who knows whether the euro is going to go up tomorrow or down tomorrow? Who knows whether the Australian dollar is going to be stable over 6 months and what the aspect is. And remember, if you're building a project, let's say you're building a project in Argentina and you're using Argentinian pesos. Well, right now, the exchange might be 1 to say 25. And as the dollar gets stronger, it might be later 1 to 20 or really 1 to 15. And if you get paid in pesos, the pesos just became weaker and you just lost money. And then finally, managing the diversity of international accounting and tax practices. And there are international accountants and international tax lawyers to do just that. So let's get started. The first one is to choose a capital structure. There is debt and there's equity. Those are the 2 types of capital structures. And you've got a mix of long-term equity and debt financing in order to do that. For instance, equity financing, generally speaking, is a long-term solution. They obtain equity financing through selling stock. So as they issue shares of stock, the more stock they issue, they're going to bring money into the organization. The problem is they're going to dilute ownership. Again, supply and demand. As firms issue more stock in order to get equity finance, the supply goes up, the price goes down. So a lot of firms don't like to do this, especially in the short run, because it's going to make their stock go down and less attractive to investors. Remember, it's all about supply and demand. The more stock you issue, the lower the price. Debt financing, generally speaking, can be either long-term or short-term. Short-term is when you go and you borrow money from a bank. If the interest rates are high, people don't like to do that. The other way is to go out and sell corporate bonds, which mature at a certain date, and you get paid an interest rate at that date. For instance, you might sell a $10,000 bond that matures in a year, and it pays 10%. So in a year, you're going to give the company $10,000 now and buy that bond. In a year, they're going to give you $11,000. So you're going to make $1,000 or 10% on that $10,000. So task 2 is raising funds. We just talked about that. In the global money market, you can raise funds a number of different ways. Number 1, you can go and you can take out a loan. That's short-term financing. But you can take out a loan anywhere in the world. So you can go to Tokyo, or you can go to Singapore, you can go to the London banks, you can go to Chinese banks, depending on who's going to give you the best interest rate, the lowest interest rate. So for short-term financing, you can go out and you can take out a loan, but there's many ways in which you can do that. For intermediate and long-term financing, generally speaking, they're going to either, if they want to go debt financing, they're going to sell corporate bonds or they're going to issue stock. But a manager needs to understand, what do I want to do? Do I want to issue stock or do I want to go into debt financing? The problem with debt financing is if someone calls your debt, the firm could be in trouble. So they want to have a mixture of financing from equity as well as finance from debt. So the major financial centers out there is New York, obviously, with the stock exchange, New York Stock Exchange and the NASDAQ. London Stock Exchange and Tokyo Stock Exchange. Those are the major centers for equity financing. So you can sell equity shares or shares of stock on any one of those financial centers. You can sell it on the New York Stock Exchange, the London Stock Exchange, or the Tokyo Stock Exchange. Frankfurt, Hong Kong, Paris, San Francisco, Sydney, Singapore, and all those other are secondary centers. They are smaller equity markets and smaller equity traders. And they, generally speaking, will sell those on secondary shares of stock on those centers. So the reason that it's become so much more prevalent for a company to raise money in a financial market versus, or I mean a world market versus raising money at home is because of government deregulation. Government deregulation has made it possible for firms to go out and get money from just about any country or any bank in which they choose. That has helped firms because it helps them lower their costs of financing, lower their costs of raising money, and it makes them a lot more sound. Remember, the more options you have, the better the quality and the lower your price. So as governments deregulate because they want to participate in these world financial markets, it becomes very beneficial to the firm. The other thing is information and communication, and also moving data or technology, moving data from one place to another as easily as we can through these large servers, through broadband, etc., has made it easy for people to get immediate quotes in the financial market and really understand where they want to get their financing from. So we talked about equity financing, that's selling shares of stock. The main advantage is firms don't go into debt. The main disadvantage is the firm's ownership is diluted, and generally speaking, the stock price falls. because of supply and demand. We talked about that. These are the world's largest stock exchange. As you can see, New York is number one with the New York Stock Exchange and the NASDAQ. London is number 2, Japan is number 3, and then you've got Shanghai, Hong Kong, Euronet, and some of these other, the Chinese Stock Exchange, and some of these others that I've never even heard of. And generally speaking, United States consumers don't do business in. However, big MNEs do. The second way is debt financing. Debt financing is borrowing money. You can do it 2 ways. You can go and you can take out a loan. You can take out a short-term loan or a long-term loan. Generally speaking, short-term loan, the interest rate's higher. Long-term loan, the interest rate is lower. So you can find whatever bank you want. You can find the lowest interest rate. You can find it anywhere in the world. You can get a spot exchange rate, or you can get a spot interest rate at that point in time and take out a loan. The other way, again, is sale of bonds. You can sell corporate bonds to either investors like banks and things like that, or to consumers. You can buy bonds. Oftentimes, government utilities will sell bonds in order to raise money for infrastructure. Those bonds carry a maturity date and they carry an interest rate. The interest rate is paid at the maturity date. Therefore, they don't have to pay back any money until it matures. They get the use of all of that money until maturity. And then hopefully by the time of maturity, they've gotten in other money from daily operations and are able to pay off that sale of bonds. So the world's primary banking center, of course, United States is number 1 down there in good old New York City. London is number 2. China is huge, and we're going to talk about that a little bit later, but China is huge in World's Bank. And the reason that China is huge is because, as I've told you before, they have a dirty float. They're keeping their UN undervalued. Therefore, they aren't importing very much because their yuan is weak, and when your money is weak, imports go down, exports go way up. So their exports have been up. They're amassing this large, huge amounts of cash. And because of those huge amounts of cash, they're able to lend that out to make even more money on that cash. So we just talked about that. It's become the world's largest economy and center of global banking because of the cash that they have, because of their huge trade surplus. We talked a lot about that in the last chapter. So with that, I am going to say goodbye for now for part 1, and we will be back in just a little bit with part 2 of global financial management and global accounting practices.